From our perspective, we actually think for the next, say, 3 or 4 years, the supply outlook continue to be stronger than the demand. Demand will remain sluggish. We think probably is about 1 million barrels per day. Supply on the non-OPEC side, driven by US, Canada, Argentina, Brazil, and Guyana, is probably going to grow faster. And this year, actually, even Norway and Kyrgyzstan, because of some major new project coming on stream, they will have a one-time modest growth for this year, even though they won't last over the next several years.
I'll get into the cycle. So I think it's just a matter of time you have to get crude oil relatively cheap, like natural gas did last year. Got to get below its cost of production to curtail these forces of excess supply and excess demand.
E&Ps or integrated oil companies in the US, should they be investing in the energy transition like they have in Europe?
Like everything else, there's no a black and white answer. It's not that you shouldn't invest in the energy transition, but should you just abandon your investment in the oil and gas and just focusing in the energy transition business? That is wrong.
Rob Barnett here from Bloomberg Intelligence. And today we've got a special guest. We have Paul Cheng from Scotiabank joining us here in the room. They've got their 53rd annual Global Energy Conference here in Miami. They kindly asked me to speak at it, and we thought we would return the favor and ask Paul to come join us as we do every week, this recording. We've also got Mike McGlone, who's based here in Miami, a regular on this call. You know him well. And so let's kick things off. We're talking big picture, and I want to get a sense. I want to read the tea leaves from you, Paul, because it's always great to hear other voices. And I'm curious if you can give us a lay of the land in terms of what are the big themes that you're looking at for the energy space here in 2025.
Thank you, Rob, for the invitation. For the big theme for this year, I think the demand and supply outlook is continue to be something that everyone looking at. From our perspective, we actually think for the next, say, 3 or 4 years, the supply outlook continue to be stronger than the demand. Demand will remain sluggish. We think probably is about 1 million barrels per day. Supply on the non-OPEC side, driven by US, Canada, Argentina, Brazil, and Guyana, is probably going to grow faster. And this year, actually, even Norway and Kyrgyzstan, because of some major new project coming on stream, they will have a one-time modest growth for this year, even though they won't last over the next several years. And I have to confess that I'm a relatively bear in China. I don't think there's any silver bullet for the economy. I think China demand growth will remain weak, probably around 200,000 barrels per day a year for the next several years. Both gasoline and distillate for China, I think they are in structural decline now. And then the other thing that we also believe, the refining market could see a new multi-year cyclical upturn, could begin that by next year.
Thank you, Paul. And once again, apologies for the technical difficulties. That seems like a relatively bearish setup if you've got supply growing faster than demand, weak outlook for China. And so, Mike, you've been beating the drum on sort of a more bearish outlook for crude oil for some time. And what do you make of Paul's comments?
Well, I was hoping we'd have some significant disagreement. We have pretty significant agreement. And it starts with the big picture, as we all know what's happening with China. To me, I traded Japanese government bonds 30 years ago, and I see what's happening with Chinese government bonds. They're collapsing for a reason. The cyclical nature of declining demand from China, massively increasing supply, excess of supply to US, OPEC. And you mentioned Argentina. It's just the macro for me is a big picture of, I'll get into the cycle. So I think it's just a matter of time you have to get crude oil relatively cheap, like natural gas did last year. Got to get below its cost of production to curtail these forces of excess supply and excess demand. And it's on the back of what always happens in history. We had the big pump to the peak in 2022, and we're still heading lower. Right today, crude oil dropped around 67. Yesterday, we're on the 26th of February, and it's bumping up around $69 a barrel. The break-even cost in the U.S. is 57. To me, that's been my long-term call. You got to get below that break-even cost to offset these things. And then we look at the macro. So to me, that's the pre-existing trends. What shifts that? We did have the world change on November 11th, and we have a U.S. administration. Its stated goal is lower energy prices and lower bond yields. And the fact that WTI peaked this year in January at 80, at the same time the long bond peaked at 5%, I think makes a tilt back towards 4% long bonds and 60 in WTI. I'm just going to be writing about that today. So I don't see what stops those factors. And I think one thing that can accelerate those factors is the elephant in the room for all risk assets, and that's a uber expensive U.S. stock market. It has to keep going up. I've been calling it the inordinate burden for commodities just stay stable. Overall commodities. And so crude oil is obviously the most significant in the world. It looks like it's tilting lower. Natural gas in the U.S. just bumped up near $4. And we've had an extremely cold winter against trends of the global warming. I think that's unable to stay much above 4%. And then we have all the other commodities like copper bumping up near $5 for a little while, U.S. copper because of tariff issues. But I don't see what part of U.S. tariffs and this pretty significant cutback of from Doge is good for industrial metals. So I see copper potentially peaking, even corn potentially peaking. And the bottom line for me is crude oil has to stay, now it's dropping below 70. It has to stay above 75 in terms of US dollar, in terms of WTI. And I think it's more likely to hit towards 60. And I think all the dominoes are heading that way. And I'll end with one of the best, most significant leading indicators on the planet, Bitcoin. And it's starting to break down like I thought it would from 100,000. So everything to me is tilting towards deflationary recession, at least a short-term correction in the equity market. And crude oil is just part of that whole macro space. That means the U.S. Trump administration is going to get what they ask.
Paul, I just want to follow up on, Mike mentioned break-evens. Do you have perspective on that for the North American landscape? What price do oil producers, E&Ps in the U.S. need in order to make money?
No, I mean, Robbie is a great question. And we really have to separate out between the sunk cost economic and that if you're talking about full cycle. When you're looking at the oil company today, because that they scale back in their capital spending at better discipline, why? Well, it's dangerous to say this time is different on Wall Street, but I do think that this time is different because the investor base in the energy land had changed. The growth investors are generally out, and so no one is paying for the growth premium, and that's why that oil companies are no longer chasing the production growth. Now, as a result of that, we have seen a tremendous improvement in their free cash flow yield generation capability. And when we're looking at most of the oil companies today, for them to be cash flow break even, if you're using, say, call it $3.50 to $4 natural gas price, you're talking about in the mid-40s before you're counting the dividend. If you count the dividend, you're probably talking about $50 on WTI. And they could be break even, or that positive free cash flow sufficient that not only to support their dividend, but actually with excess.
And so if 50 is the break even, do you anticipate continued U.S. output growth given that we're higher than that?
Well, I mean, we will, but modest. If you're looking at today, no company is talking about a double-digit growth. Why? Well, because the market won't pay for it. And so today that the oil company is looking at somewhere between 0 to 5% oil production growth, and most of them is probably more like in the break-even 0 to 3% kind of range. So that, if you look at in the U.S. last year, that we probably in the crude oil excluding NGL, we grow in the shale oil probably say call it 300,000 barrels per day. This year should be similar. We don't see that the program is going to be meaningfully different.
Can I just piggyback on that a little bit? The headline that came out that struck me this morning when I was commuting, hearing about BP cutting back on renewable energy sources and going right back to fossil fuels. I mean, the world changed on November 5th. And I think that's part of the significance that happened. In the meantime, we have this massive proliferation of EVs. So this normal tendency for energy prices to get cheap is hitting at a paradigm shift with what's happening with demand in China and EVs.
I think in Europe, both BP and Shell is in the making of the change in the strategy, right? I mean, BP for the past 6 months has been signaling they are changing their strategy again. Quite frankly, that I think back in 2020, all the European producer that they have the knee-jerk reaction, and BP famously came back say, oh, I mean that the petroleum or oil demand already peaked structurally in 2019, and we will never going to see that demand level again. That's what BP said. And subsequently that they say, oh, yes, easy. I mean, we're going to allow our oil and gas production drop 40% between 2019 to 2030. I mean, that's just plainly a wrong assumption and wrong strategy. And so that they've been discussing that to change. And to be quite frank, that a lot of their investment in the renewable has not proved to be profitable. That's why that the stock was trading at a major discount to the US stock. And so, I mean, to me, I'm in the camp that I believe you probably need all the different forms of energy. And it is true, oil demand at some point globally is going to peak, and probably sometime between 2030 to 2035. But keep in mind that even after they peak, they have a long tail. The initial years, you're probably talking about less than 0.5 percentage point of the underlying demand increase a year initially, and then you probably accelerate later on. On the other hand, that the underlying supply curve, we do have a natural decline rate. I mean, once you pop a hole on the ground, that's your peak production. And then because underground pressure starts to drop. And so after you take in all the consideration of the maintenance capital, small project, the global oil supply probably still have a decline rate somewhere in the 2 to 4%, where you need major investment to kick in to fill the gap. And so even when we see peak oil demand, doesn't mean that oil price will actually drop, at least not initially.
What's your sense on, given that outlook, what's your sense on U.S. companies and whether E&Ps or integrated oil companies in the U.S., should they be investing in the energy transition like they have in Europe? Because I think some of them are. They tend to be a little bit more biofuel focused, hydrogen focused in the U.S. But is that something that you think should just be tabled across the board now? Are there certain areas where that might make sense?
Yeah, I think like everything else, there's no a black and white answer. It's not that you shouldn't invest in the energy transition, but should you just abandon your investment in the oil and gas and just focusing in the energy transition business? That is wrong. And given that, you also need to be realistic about the market opportunity availability. So you shouldn't force the investment because you have some kind of artificial target. You say, oh, I need to get to 10 gigawatt of renewable energy power. You shouldn't set that target. You should be saying, okay, we're going to focus based on what is the market availability. And if the market is now that here and I can generate the return, I will make that investment. But you should start making the investment, or that put the foundation so that you can make the investment. But should you spending 30% of your future CapEx allocated to the alternative energy today? I don't think so.
Mike, there's been a lot of discussion about the move from big oil to big shovel. And so a lot of the clean energy technologies, setting aside whether they have good return profiles or not, definitely require a lot of things that you dig out of the ground. What's your read across for copper, nickel, other materials as a result of the energy transition?
The macro big picture that I enjoy is it brings out the assessment I learned from it was a Bloomberg headline that what we assume generally doesn't happen, and that macro is copper is going to go up because of decarbonization, electrification, everything. And that's been wrong for quite a while. It's inching higher. But the macro has got to start with China. And China in decline. I mean, to me, I've seen this before in Japan. I used to work for IBJ, which is now Mizuho. And so the key thing I'll point out about the copper in the short term, what part of US tariffs and US DOGE is good for global demand for industrial metals? Nothing. They're getting short-term blips, particularly in US copper. So I think copper's peaked for this year. I'll make my call on that at 484. It was a pretty significant breakout versus LME copper, similar to last year. Now we have some nuances with what's happened with tariffs. And I think it's heading more to, it's basically about 450 or so right now. I think it's heading more for 4 or lower with bond yields, potentially. If you take copper and overlay with a bond yield, it's similar. But the key thing is from my colleague Grant Spore in London, who digs into the supply and demand, this is slightly oversupplied. But to me, I always look at the industrial metals as on the completely, Dr. Copper. I mean, what does it mean for the global economy? And I like to focus on what are you seeing from sovereign bond yields? You look at the top 5 countries in the world outside the US, their average bond yields, which is Japan, Germany, UK, obviously China, and India, their bond yields are 100 basis points below the US. Before the 2008 crisis, they're 100 basis points above. So that shows the global tilt towards deflationary, recessionary forces, and industrial metals are in the space. So a key thing I like to point out is you look at gold versus copper, that ratio has been heading higher. Gold versus industrial metals. That ratio, US Bloomberg Industrial Metals, is in a very much economic danger zone. And it never stayed there for this long where we are now. The last time we were at certain levels where we are right now was 2008 crisis and then the peak in 2020. So I see that whole space at risk of going lower. That's why my focus has really been on what's happening in US bond markets and why the US stock market has to stay high. At some point, we're going to get to a point where this whole decarbonization, electrification will really benefit copper industrial metals. But to me, it's still more the macro tilt heading lower. And it's what's happening in the US. Increase in tariffs and DOGE. That's just not good for these industrial metals. The key things also remember is there's some in the long term, metals are usually best you can invest in the actual metal, i.e. gold, but in equity, in energy, it's much better typically in equities for total return.
Okay, so Mike, you mentioned policy, you mentioned tariffs, DOGE. So Paul, I want to get a sense, does who leads the U.S. really matter? Are you worried about tariffs being a headwind? The U.S. conversation seems to have switched from energy transition to energy dominance. And I think that basically means it's not just renewables anymore in the U.S., it's oil, gas, and probably still renewables. But what's your sense? Are you worried about some of the political headwinds?
Absolutely. We should be. To put it into perspective, looking at Mexico, we import about 400 to 500,000 barrels per day of predominantly heavy oil from Mexico. If we put a 25% tariff on them, most likely is that those oil will shift to other countries and we will have to import from other countries. Now, that means that our transportation cost is going to be higher, and that probably need to either absorbed by the oil company or that the consumer will need to see a somewhat higher prices. But that's relatively okay. I mean, that in the end, 500,000 barrels per day is not a lot of oil that on the global market, we should be able to find the alternative. The problem, though, is that while that we import about 400,000 or 500,000 barrels per day, 50 to 60% of our gasoline export, gross export, go to Mexico. 25% of our distillate and jet fuel also go to Mexico. So we export about 1.3, 1.4 million barrels per day of refined product. And so it's reasonable to assume if we slap them with a 25% tariff, they probably slap us with a 25% tariff. And so what will happen? Then your product could not go to Mexico. You have to find some other market. And that is going to be far more costly. And if you cannot find sufficient market to replace that loss in Mexico, then your utilization rate will need to go down. But of course, in a commodity business, your utilization rate will not voluntarily go down. That's only go down for one reason, is your margin need to drop down. Now, in terms of Canada, right or wrong, we import a lot of Canadian oil. and then a lot of the heavy oil. And US actually don't really produce much heavy oil. And so that means that if we put the last time we talked is 10%, 10% tariff is probably a little bit more easy to handle on that. At today's oil price, you're talking about $6. And I think 50 to 75% probably will be absorbed by the producer for one simple reason. They could afford it. Refiner could not afford that to absorb the majority of the tariff, even if it is just $6. And so is that a concern? Yeah, because that if we put in into the tariff, you're going to see higher pump price and higher diesel price and jet fuel. So consumers have to pay a bit of that. And then the refiner also take a little bit of the hit.
Can I follow up on just the Canada-US relationship? So President Trump yesterday was tweeting about reviving the Keystone XL pipeline. I'm curious if you think that could happen. And what's your sense on the Canadian producers? If they are going to take the hit, will there be a lot of effort to get pipelines that bypass the US built in Canada?
I think logically that if we put ourselves into the shoes of the Canadian, that's the first thing I would do. Why revive the Keystone? I mean that remember that people lost billions of dollars on the first attempt to build the Keystone, and that do you really want to go down again? And besides that, I think the classical business school economic 101 will tell you you do not want to be captive to one supplier or one customer. And so why should Canada do that?
Mike, what do you make of the tariff potential impact just on how you think about commodity markets here in 2025?
I appreciate you going there because I wanted to ask you both the question. First, I look at it. Let's start with the most significant thing that's really happened in my space is this big disparity because of tariffs and CME traded copper versus LME traded copper. Right now, it's about a 5% premium. Historically, it's zero. The peak about a couple of weeks ago, Valentine's Day was 12%. That always means highs in copper. But I look at it in a macro standpoint. You see short-term discombobulation, maybe with supply demand in the U.S., but it's a global macro market, and markets will adjust. The key thing I want to ask you is when I think about imports and exports in the U.S., I look at the macro net. So net U.S. imports, it's a significant index on the Bloomberg terminal. I think we get the data from the Department of Energy. Are now net exports of 4 million barrels a day, crude oil and liquid fuel. I include liquid fuel, farm background, 15% or so of our unleaded gas in this country is from unleaded, is from ethanol. But our net exports are now 4 million barrels a day. 2008, when crude oil peaked at 147, it was the net imports of 11 million barrels a day. So I get the difference. There's issues with light and sweet and heavy crude, but I don't understand how difficult is it for a refinery just to readjust to maybe take a different type of crude versus you're not building a new refinery. So to me, the macro is tariffs and things are short-term discombobulating for crude flows. But the key thing for me, I don't understand is to me, macro big picture on a global space, this just means less demand for fossil fuels, industrial metals, because most of these exporters to the US are not going to be able to have that revenue anymore from exporting products. So, but to me, when people point out the little things, I think, well, the macro looks like it's going to be short-term.
Yeah, to put it into perspective, actually, that is far more difficult to do it than say.
Exactly.
To trying to switch from a heavy oil diet into a light oil diet. I mean, to some degree that we have done that in the Gulf Coast because of the shale oil development that over the past 10 years that if you're looking at the Gulf Coast refineries, we have processed far more light oil today than before. But on the margin, you can do that. I think it's important to recognize that for the refinery, in order for them to switch it, you have to significantly expand your light oil handling. No one is going to take out the heavy oil processing capability. But when you increase your light oil handling, that it may impacting the rest of your conversion unit. So a lot of bottleneck will start to create. And so I think that within a Trump administration, at most that if we're willing to do that, we may be able to increase the light oil processing by 10, 15%. otherwise, I mean, I think that if you're going to do more than that, you probably is going to see a reduction in your total utilization rate, or that the availability of that, how much you can run. So in other words, that if you have using Whiting as an example, the BP Whiting refinery, 400,000 barrels per day, they run, say, call it 275 to 300 of the Canadian heavy oil. Can they cut that by half? The answer is that no, unless that they're going to run at a substantially reduced throughput level compared to the capacity.
So I appreciate you mentioning Whiting, because I'll be there. I'll be like 50 miles away next week. My family's from there. I just remember as a kid always driving by Whiting, you can smell the sulfur. I just didn't realize it was the biggest refinery in the country, or one of the biggest.
One of the biggest.
Yeah.
Paul, I want to probe a little bit more on this idea. So if the U.S. has to, if we essentially have to reshuffle where oil goes to get processed, where does that heavy crude go if it doesn't come to U.S. refineries anymore? Can China process all the heavy crude that's out there in the world? Does some of it go to Europe? Where do you think it happens if we reshuffle?
Rob is a good question, right? So if you're looking at globally, the demand for heavy oil in theory didn't change. It's just that you're changing the flow of the heavy oil, where to go. And so in theory, that if we no longer take the Canadian heavy oil, we will somehow try to get the oil from the other market, like the Latin America, the Ecuador, the Colombia, the Brazilian heavy oil, and then the heavy oil from the Middle East, ship it to the Gulf Coast. And we probably that in a number of years that we reverse some of the current pipeline, instead of going south, reverse it back to going north and ship those heavy oil. So you may actually see Cap 9 being reversed again, shipping the oil back up into the Midwest with heavy. So you do that. Now, in a number of years, if after we do all that, in theory, your heavy oil output the demand didn't change. And so that means that the rest of the world will be able to pick up the Canadian heavy oil, that they are no longer going into the US. But in the short term, chances are that if we really put a tariff, 10% may not be that bad, but when you put 25% tariff, end up is that you're probably going to see a reduction, unless that the producer is willing to absorb 75, 80% of that. If not, then you're probably going to see a reduction of the throughput. So the actual demand for the heavy oil become a little bit lesser. And the supply for the Canadian. Now, remember, the Canadian doesn't have a lot of flexibility because they don't have a lot of inventory. They do not have a lot of storage up in Alberta. So if they can't sell it and ship it down, then they have to shut their well. And shutting the well for 4 years, throughout the entire Trump administration, that's not really a practical solution.
So we're coming up on the end of our time here, but we haven't talked too much about natural gas. And I want to get a sense from you. Natural gas has generally been part of that bigger picture energy transition narrative. We've seen the gas weighting on a lot of the U.S. companies in particular grow, but European majors as well. So give us a sense of how do you read the future of gas? Is LNG really the growth story that everyone thinks it is?
Well, LNG definitely is a growth story, right? So we continue to see a tremendous, especially under the Trump administration, we no longer put a stop in issuing the permit. So you should expect that continue to grow at a pretty rapid pace over the next, say, 4 years, at least that the number of projects being sanctioned. Now, if we have to separate out between the North American market and the global market, with the wave of new LNG facility coming on stream, whether it's from the US Gulf Coast, from the west coast of Canada, BC, the LNG Canada, or from Qatar, that they have over 60 million ton of annual capacity coming on stream over the next 2 to 3 years. All those means that the global spot gas market, like TTF or JKM, between 2026 to 2028 or 29, probably will be relatively depressed. Now, not to mention if we do have a cease of fire between Russia and Ukraine, then the Russian gas will start to be flowing again. And so that the gas market is actually going to be probably a little bit more problematic on the overseas market. In the meantime, that the US market is going to go through every 2 to 3 years of the up and down cycle, because we do have a lot of resources. It's just a question that when that you have the economic to drill. So what you end up is that like last year, gas price very depressed, so no one drilling. Rig count has been dropping. And this year we have very strong demand triggered by initially that of course is the winter. And so gas price is now over $4. So end up is that you're going to see this kind of cycle when at $4, everyone is drilling. The economy is too good.
So I like that you mentioned TTF. So European gas price typically ranges kind of 5 to 8 times Henry Hub. Do you have a sense that as LNG progresses, will we ever see a price point for gas like WTI? So we have this big disconnect between U.S. gas price and European, Asian gas prices. But will we have a more global type price in the future for gas as well?
I don't know what Mike would say. I mean, from our standpoint, the answer is probably no. LNG, if you look at the take-or-pay contract, majority, I mean, all the major oil companies, I mean, they're not talking about, say, the merchant LNG operator, but if you're talking about the major traditional LNG producer like Exxon, Chevron, and all that, majority of the take-or-pay contract is still linked to oil prices. Today, you no longer see the curve at 16%, but more like in the 12 to 13%. So in other words, that your Brent price is $70, that you're talking about, say, 6 to 1, through the map, $70, 6 to 1, and then you're talking about a 12%. So we are talking about, say, maybe $9 on that. And so that's what I think today most of the long-term take-or-pay contract is being signed. But that if you're looking at the spot market, possible that it could drop below that. Now, however, that how low they could be become, it somewhat depends on also whether Russia that with the Ukraine war is going to have a peace agreement, and then the sanction will be lifted. Otherwise, that if you're looking at today, the U.S. gas price is about $4, and you take about probably $3 for the for the processing fee, and then you take another $2 or so that you ship into Europe. So you need to be probably $5 to $6. And so if you're $4, then you probably need at least $9 to $10. Otherwise, that the arb won't open.
Mike, any concluding thoughts on gas?
Yeah, I appreciate your point about anytime gas gets in there for supply comes on strongly. The key thing that's shockingly happening globally is drilling technology is just taking off. I mean, now you can drill, at least in shale, you don't just drill one drill now. You drill how many horizontals? And I just love this rig count thing for crude oil. It's been wrong forever. I mean, U.S. rig count is the same they were 10 years ago, yet U.S. crude oil production's increased. Now, for gas, it's the key fact. Every time it gets in there 4, supply comes on, break-even costs around 2, goes back to 2. It took the Russians' invasion of Ukraine to pop up down 10, which brought it back down to 1.5, and here we are back at 4. So the key thing I like to point out, and I'll end with, is the trend in global warming is for warmer winters soon. We just had a really cold winter, which means probably next year it's unlikely we're going to get another colder winter. It means gas goes back to 2.
Okay, I think we're going to leave it there, but thank you both. Paul, I love that you whipped out an old school calculator. You were ready to do a little bit of math for us. My children, I don't even think they really use calculators anymore. They tend to do more PC based. Yeah, the Excel type tools are sort of in their sort of mindset at this point. But anyway, so we hold these calls every Wednesday at 10 a.m. New York, 3 p.m. London. Make sure to catch the next one. And thank you again so much, Paul, for joining us. And Mike, as always, you're welcome at the table. So take care, everyone. Be in touch.